Sup guys, Christos here. Today I want to talk about a mistake that I personally believe everyone has made to some degree anyway when investing into the stock market. This is a mistake that has personally cost me thousands of pounds in capital gains, and a mistake that brings me so much pain to see people making on a daily basis. So in today's video, I'm of course going to share that mistake with you guys, and most importantly, I'm going to talk about what you can do to steer clear of it in the future. So having said that, hit that like button down below and let's jump straight into it. Okay, so the mistake that I'm talking about today is trying to time the market. This, in simple terms, is where an investor tries to pick a perfect time to buy a stock when it's at its lowest price, of course, and also the perfect time to then go and sell the stock, which, you guessed it, is at its highest. And whilst this sounds like the perfect strategy, of course, to make lots of money, the fundamentals and the skill/luck required to actually make this work makes it one of the worst strategies in the investing world today, in my personal opinion. If you want to know the typical person out there that seems to try and time the market every single time, just ask yourself, how many times have you heard someone say, "I'm waiting for the next big crash," or "the stock market is too expensive right now"? Well, these are in fact the people that are simply making the mistake of trying to time the market. Most of these people would have likely been saying the same thing for the past 5 years, because going off averages, the stock market is due to crash roughly every 8 years. And just putting the small one in March of 2020 aside, this doesn't seem to have happened yet in the past 13. Furthermore, if those people would have decided to invest 5 years ago instead of waiting for the crash, just taking a look at the percentage gain of the S&P 500 of 114% over the past 5 years, they would have actually doubled their investment, but instead their cash savings would have ended up wasting away due to inflation, and their beliefs of a stock market crash would have only grown stronger because, well, they're simply those types of people. Now, of course, all of this is very easy for me to say because, after all, I have only been investing in the market when it's been good, and in my adult life, I have never actually experienced an economic downturn. Don't worry, I fully get that. However, it's not just my own personal experience that proves timing the market to be a terrible mistake. There are actual figures based over the past 2 decades to also back this argument up as well. For example, taking a look at this infographic, what you can actually see here is the performance of $10,000 invested into the S&P 500 between 2005 and 2020. During this time, this investment would have also gone through the Great Recession and the housing collapse of 2008, and also the Corona collapse in early 2020. So, having said that, it's safe to say that it would have seen both the great periods and the not so great periods in terms of the spells of the stock market. Now, if we take a look at the different figures, if you would have actually just invested the entire $10,000 and left it for 15 years, you'd have actually finished with $41,000 and £100, which is an average annual return of 9.88%. Not bad if you ask me. However, let's say you were trying to time the market and you were taking your money in and out all the time, and you happened to just miss only the 10 best trading days during that entire 15-year period, you would have still made money, but it would have been under half of what you would have made if you just left it in the market and forgot about it. One thing that you would also have done is save thousands of hours of research, because simply trying to time the market isn't something that we have just built in us as an instinct. It would require countless hours of researching different chart trends and technical analysis and looking into many different factors. And then finally, just going back to the chart, what you can eventually see is as you miss more and more good trading days, the money gets worse and worse, to the point where all you have to do is miss the best 30 trading days during those 15 years to in fact bring in a net loss over that time period. So having said that, I think it's safe to say that both my opinion and these facts prove that trying to time the market and wait for market crashes is actually a massive mistake, and it can cost you thousands of pounds or dollars over the long term. So having said that, how should you approach investing, and how can you actually avoid making this mistake going forward? Well, for me, there's 3 key things that I personally like to do and think about, which I think gives me the best chance of making money over the long term. Number 1 is to pick companies that you understand and that you have done your fundamental research on. Now, of course, this is much easier than me just saying it in this video. There is a process that you should take when researching a stock, and what I'm actually going to do is throw a video in the description of this video for you to check out on how I actually do that. Now, for the second step, what you are going to want to develop is something what is called a long-term investing mindset. And what I'm not saying here is that you should only think of selling the company in 20 years. That's not what I mean by a long-term investing mindset. What I'm more saying is that if this stock was to crash tomorrow, you would be absolutely fine, because in step 1, you would have done your research and you would have understood the company, and you know the core fundamentals of the business will come through, and eventually the stock price will go up, and you will not be fazed by the short-term swings in the stock market. What I've done right here is quickly sketched out what a typical trading chart would look like for a growing and successful company over 10 years. As you can see, the green line represents the short-term price movement in the stock price, and as you can also see, it's sometimes low and it's sometimes high. However, what is most important is the black line, which represents the company's actual performance and growth. And as you can see, as this line goes up, so will the fluctuations in the share price over the short term. So the key thing here is what I'm trying to say is that you need to focus on the company's fundamentals. And if this company is producing great growth, great revenue, and great earnings, over time, the stock price will eventually catch up. And then finally, the third thing that I do is actually deciding how much I want to invest into that company. And the one thing that I think is extremely important when you have found your stock, you've done your research, and you want to invest and you're ready to go in, never go all in. What I actually like to do is actually build up my position in a company slowly over time to make sure I'm actually getting the best price. This is, of course, more commonly known as dollar cost averaging, and the reason why it's so powerful is, let's say you decided to invest into a company for the next 10 years and you had $10,000 to invest, and you decided, right, I'm going to invest all of that $10,000 straight away. Now, let's say that the next day the stock market does crash, which is always a possibility. What you have now is all of your money invested currently at a loss, which, if you did pick a good company over time, will likely correct itself and end up actually making money. However, let's say you only decided to invest half of your money to start, and the same thing like a crash would happen, and you still held that long-term mindset. What you can actually do is invest the remainder of the money that you had at the start at a much lower price, which over the long time is actually going to make you more money because you are getting the stock at a cheaper price. And I guess the final thing to say when it comes to dollar cost averaging, or DCA as some like to call it, it's extremely important that if you do decide to go down this route, then you consistently invest, and that should never be an issue, because at the end of the day, if you are researching great companies that you believe in, you should never be hesitant to pick up that stock at a cheaper price. For example, if you were averaging into a stock and the price dropped a considerable amount and you were hesitant to invest a small percentage of your allocated capital, that could be an actual warning sign that you no longer believe in the business model anymore, and it could actually be a flag to maybe even consider selling that stock. Dollar cost averaging for me is such a vital part of my investing strategy. It allows me to get, like I said, companies at a cheaper price, and it also allows me to reduce my risk because I'm not going all in on a company, and if it was to crash, I wouldn't have to wait years for that stock price to actually recover. So, just to summarize, number 1, time in the market will always beat timing the market. Number 2, pick great companies where you believe in the business model and the company's future outlook. Number 3, develop a long-term mindset around investing. And then finally, when you do want to invest, never put all of your money in straight away. Build a position up over a certain period of time to make sure you get good value on your money. But having said that, that is the biggest mistake that I see new investors make when it comes to investing into the stock market. It's certainly a mistake that I definitely made myself. And I think that if you can learn to avoid this kind of mindset where you're trying to time the market all the time, you will definitely be better off in the long term. So having said that, if you did enjoy this video and it was valuable to you, I would really appreciate it if you left it a like down below. Any questions, do leave me a comment, and I will catch catch you guys in the next one. Take care.